Hey, it's Jaymes Willoughby. Today I want to introduce to you the 2-1 buy down and the 3-2-1 buy down, specifically for buyers that are concerned about their mortgage payments for the first couple of years, which is usually the toughest time. They call it payment shock when you're at a certain payment, either rent or lower mortgage, and then you jump up to a bigger mortgage. And yes, there's tax savings involved, and of course you're getting presumably a bigger, nicer home or whatever. So the assumptions we're going to use on this is a purchase price of 500 with 20% down, 7% interest rate on a 30-year loan gives you 2661 mortgage payment. Now, a 2-1 buy down means we're dropping the payment 2% the first year. So instead of 26, you're paying 21. You're saving over $500 per month, and over 6,000 per year. Year two, you'd be at 6%, still saving a significant amount of money over the fixed rate at 7%, and saving quite a bit of money per year. And at the end of that year, you switch back to the 7%. So then you're going to be fixed at that payment. Chances are you'd be able to refinance in the next 3 years to lower than the 7% anyway, if you listen to any of the experts out there. Now, by the way, it's going to cost the seller 1.865% or $9,300. So instead of dropping your payment or dropping your price rather by 10 grand, why not just pay a 2-1 buy down for the buyer? It's more of a win-win scenario. Now, there's a version of this program called a 3-2-1 buy down, which not a lot of people talk about. When I was selling homes in the 80s, the 3-2-1 buy down was actually what we did on nearly every home because rates were a lot higher. In fact, my first home I bought at 14%, and the first home I ever sold was 16.5%. So you can imagine what it was like back then in terms of the payments. So if we're still at the 7% fixed, the first year on a 3-2-1 would be 3% off or 4%. You can see that a significant monthly savings of $751. The next year, you're going to save that $500, and then you're going to save another $263 in year three before it fixes in year four at 7%. So over the course of 3 years, you save $18,000. The seller would have paid 3.6% of the sales price to make that happen. I'm seeing sellers cutting their price by 3 and 5 and even higher percentages right now. So why not consider doing a 2-1 buy down or a 3-2-1 buy down for your client to make things work? What's so interesting is I introduced the 5-year ARM, which ironically is fixed for 5 years, and the rate was at exactly 5% when I showed you that, and still is. So if we did a 2-1 buy down off of 5%, that means you'd get a 3% fixed rate the first year, and it's only showing $460 savings. But remember, this was over $2,600. So there's another $500. So you're saving nearly $1,000 a month in savings if you were to do a 2-1 buy down off of a 5% fixed ARM. Fixed ARM being it's fixed for the first 5 years at the 5% note rate. So significant savings. Now, my computer doesn't show the difference between the fixed rate and the 7% fixed and the 5, but we'll go back here and look at it again. It was $2,661 is the note payment at 7%. When we drop it to 5%, it's only $2,147. So that's actually more than $500 savings just with the ARM alone. So I think that before you get too fancy and start asking for too much money as a buyer from the seller in terms of concessions, I would go with the 5% ARM, which is fixed for the first 5 years. And then maybe we could squeeze this 2-1 buy down and you'd be at 3% the first year. So you would save basically another $500 on top of the $460. So you're saving $960 plus per month. That's significant. So think about it. Start talking to your mortgage loan officer about 2-1 buy downs and about the adjustable rate mortgage with the 5-year fixed terms. So we call them a 5-5 arm, which means it'd be fixed for 5 years and then adjust every 5 years for the next 5 years. That has some significant impact. If you have any questions, be sure to reach out. We appreciate you listening today.